Friends, in this video for I Thought Wealth, I am going to talk to you on the topic micro cap and small cap valuations. I have been investing in both these spaces almost right through my investment career, and interestingly, today the valuations of these businesses are at an all-time high. I don't mean to talk about the market caps of companies, but what I am trying to tell you is that the valuation in relation to earnings is at an all-time high. One thought that 2018 or 2017 end and 2018 January was an all-time high, but today I find that most companies are trading at a valuation way higher than even that valuation. Generally, when you see why this happens, it's almost always a function of liquidity, scarcity of ideas, concentrated ownership of shares, and lack of alternate avenues. Today, if you see, why is there such a clamor to buy micro cap and small cap companies? Obviously, the historic returns look as best as they can be, and people feel that even if I can get a part of this historic performance into the future, that will still be better than keeping my money in a bank. The fact that money kept in a bank is not going to give any return, that money actually loses value against inflation, has made a lot of people jump fences from debt into equity, and those coming into equity are going to invest directly in equity, and these investors want to try their hand with these small and mid cap companies and micro cap companies so that they can raise their returns. What effectively people are raising today is their risks. The logic is very simple. These valuations may not sustain if the liquidity tapers down. You don't even have to see interest rates rise. If around the world the liquidity is reduced, that itself can change the valuations of micro cap and small cap companies. Clearly, the last 2 years have seen them benefit from everything. When commodity prices crashed, they got margin expansion. When commodity prices are rising also, they are benefiting from it because they are having low value inventory. But all this need not necessarily sustain, because we have had the most extraordinary economic circumstances in the last 2 years, and we could see very different economic circumstances the next 2 years. We don't know where inflation is going, and generally from my experience, when inflation rises, the companies which have lesser resilience are the micro cap and the small cap companies. Growth is also not a given, and we are going to see that companies which did exceptionally well in the last 2 years may not be able to sustain this performance going into the next 2. Given all these factors, I think that investors must be cautious at these valuations in micro cap and small cap. I believe that if valuations are higher than their historic multiple or their historic trend, you should take some money off the table so that you are at least safeguarding a part of the profits that you made. As valuations remain high or even become more irrational, you can take more money off the table and reduce or moderate your risks through lower position sizing. So that is something which you can do. Many people have seen stocks move from 6-7% allocation to 15-20%. They have allowed profits to run, and it has definitely rewarded them beyond even their own expectations. But given the current trend in valuations, I believe that risk mitigation is a higher priority, something which you should lay more emphasis upon and give more attention to in your portfolios, especially with the micro cap and the small cap companies. Effectively, valuations change according to the economic context, according to the growth prospects, and according to the availability of opportunities. Now, with so many companies coming to the market with more product options available to you, with more investment options coming up before you, I believe that the markets will definitely change their focus from investing in these high risk businesses towards investing in other businesses which offer higher profit prospects with lower risk. So, markets will definitely mitigate risks. Large institutional investors are likely to mitigate risks. It is the retail investor who has to take the initiative to manage his risks better at these elevated valuations, so that if the markets see a correction or a contraction in valuations, you are not caught on the wrong foot. If you like this video, do share it with your friends who are avid investors in micro cap and small cap companies. Do stay the course on this journey with us. Thank you.